Stop whatever you're doing for a moment, because what I'm about to explain is not just another silver price prediction. This is a warning. A warning about a structural fault line forming beneath the global silver market one that could snap suddenly, violently, and without giving anyone time to react. The global silver market is approaching a moment of reckoning. What appears on the surface as another strong rally in a volatile commodity is in reality the visible edge of a much deeper structural fracture, one that has been forming quietly for years beneath the paper markets that set the price of silver. According to veteran precious metals analyst Peter Krauth, silver is no longer simply undervalued or poised for a cyclical upswing. It is nearing a disorderly repricing event, driven not by speculation or sentiment, but by mathematics, physical scarcity, and a supply system stretched to its limits. The idea that silver could reach $125 per ounce by 2026 may sound extreme to casual observers, but Krauth's conclusion is neither speculative nor sensational. It is derived from historical patterns in the gold-silver ratio that have repeated with remarkable consistency over the past 3 decades. More importantly, it is reinforced by tightening physical supply conditions that are converging toward a breaking point. Yet the most unsettling aspect of this outlook is not the price target itself. It is the mechanism that could propel silver there suddenly, violently, and without warning. A force majeure event on the Shanghai exchange. A force majeure declaration represents the ultimate failure of a futures market. It occurs when an exchange is unable to deliver the physical metal promised under its contracts and is forced to settle in cash instead. In most markets, such an event would be disruptive. In silver, it would be catastrophic. Silver is not merely a financial asset. It is an industrial necessity. Major buyers in Asia use futures contracts not as speculative instruments, but as guarantees of physical delivery for manufacturing, energy infrastructure, electronics, and advanced technology. Cash settlement is not a substitute for atoms. Factories cannot run on currency, and supply chains cannot be maintained with paper promises. Krauth warns that inventories in Shanghai have fallen to their lowest levels in a decade, while vaults in London and registered stocks on the COMEX continue to tighten. For years, the global silver market has functioned as a shell game, with metal moved between London, New York, and Shanghai to maintain the appearance of adequate supply. This shuffling creates liquidity illusions without creating new silver. The total amount of metal remains unchanged, and increasingly, it is being consumed faster than it can be replaced. This structural vulnerability is colliding with a historic technical event. Silver has decisively broken above the $50 level, a price ceiling that it held for 45 years. Since the Hunt Brothers episode in 1980, every attempt to break through this level had failed. Even during the powerful rally of 2011, silver was repelled just short of a sustained breakout. In financial markets, such long-standing resistance levels carry immense psychological and structural significance. When they fall, they do not vanish. They invert. Former sellers become buyers. Algorithms reverse direction, and the market enters territory with no historical resistance above. With the chart offering no prior reference points, analysis must turn to the gold-silver ratio, the most enduring valuation framework in precious metals markets. In April, this ratio reached approximately 105, indicating that silver was at one of its most undervalued levels relative to gold in modern history. Since 1997, the average ratio has hovered near 55, and in every major silver bull market, the ratio has not merely reverted to the mean but overshot well below it. Krauth's study of the last 5 major cycles shows an average compression of approximately 44%. Applying this historical behavior produces outcomes that are already beginning to materialize. At $4,000 gold and a ratio of 59, silver prices move into the high $60s, a level already surpassed at $4,400 gold and a normalized ratio near historical averages. Silver approaches $80, a price the market has recently tested. In a more bullish but historically consistent scenario, where gold reaches $5,000 and the ratio overshoots toward 40, silver reaches $125 per ounce. These projections do not rely on crises, manipulation, failures or geopolitical shocks. They rely solely on mean reversion and overshoot forces that have defined every prior silver bull market. What transforms this statistical outlook into a potentially explosive event is the state of physical supply and demand. Silver consumption is accelerating across multiple fronts simultaneously. Solar energy requires vast quantities of silver, with global capacity projected to triple by 2030. Artificial intelligence infrastructure depends on silver's unmatched electrical conductivity. Electric vehicles consume significantly more silver than traditional automobiles, while medical devices, electronics, and global electrification add persistent demand pressure. Against this backdrop, mine supply remains largely stagnant. Most silver is produced as a byproduct of other metals, limiting producers' ability to respond to higher prices. Recycling provides only marginal relief, as much industrial silver is permanently lost. The result is a structural deficit that is steadily eroding above-ground inventories. Each year, demand exceeds new supply, and the shortfall is met by drawing down existing stocks. This dynamic cannot persist indefinitely. Krauth characterizes the looming force Majeure risk not as a black swan, but as a gray rhino, a highly probable, high-impact event that is clearly visible yet broadly ignored. Should Shanghai fail to deliver physical silver even once, confidence in the paper market would collapse instantly. Industrial users would rush to secure remaining supplies. Inventories would be exhausted, and the price of physical silver would reprice upward in a matter of days, not months. This repricing would be amplified by psychology. As gold continues to make headlines with record highs, investors priced out of gold naturally turn to silver, drawn by its lower nominal price and historically superior upside during ratio compressions. This dynamic fuels a self-reinforcing cycle of attention, research, conviction, and fear of missing out. Even the bearish scenario underscores the asymmetry of the current setup. A pullback toward $50, the former ceiling turn floor, presents the downside case. The upside, however, extends toward $125 and potentially beyond in the event of a delivery failure. The risk-reward profile is therefore profoundly skewed, with limited downside and extraordinary upside. Silver, today, occupies a unique position in the global financial system. It is simultaneously a monetary metal, a strategic resource, and an irreplaceable industrial input. The market mechanisms that have suppressed and distorted its price for decades are being overwhelmed by physical reality. The shell game is nearing its end. When the final shell is lifted and the metal is no longer there, the repricing will be swift and unforgiving. In this context, $50 represents the floor, $125 the waypoint, and force majeure, This is not merely another commodities cycle. It is the most consequential silver setup in nearly half a century, and the conditions that could trigger its resolution are already in motion.